There's one trait that separates an average investor from an exceptional investor. It's not intelligence or experience or even strategy. It's emotional regulation. That's the ability to do absolutely nothing if, and inevitably when, markets start to fall. It's a discipline to not ditch your long-term plan just because everyone else is chasing hype. It sounds simple, but in practice, this is where most investors struggle. They panic, they sell, and they miss the exact moment the market turns. And that one mistake can cost them years of potential returns. The Saver to Investor series is brought to you in partnership with iShares by BlackRock. Last episode, Tom set up a dollar-cost averaging strategy, automated his investments, and reinvested dividends. On paper, he's doing it right. But none of that matters if he can't stay consistent when markets become volatile. Let's set the scene. Tom's portfolio turns red. Headlines start talking about a market crash, and suddenly doing nothing feels like the wrong decision. This is the moment where investors can panic. They sell down or change their long-term plan that they committed to when markets weren't flashing red. But zoom out and you'll see a very different story. Market drops aren't rare. They're actually kind of normal. Over the past 50 years, global markets have dropped 10% in more than half of those years. And 20% drops, they've happened more than a dozen times. But here's the kicker. The market doesn't stay down forever. Historically, markets have recovered, sometimes quickly, sometimes gradually, but over decades, markets have shown a consistent upwards trend. The hard part is believing this when you're watching your own portfolio go down. Quick pause. This series is brought to you in partnership with iShares by BlackRock. If you're looking to invest in ETFs, iShares gives Aussies access to countless market opportunities through over 50 locally listed ETFs. Curious to learn more? See how ETFs might fit into your own investing journey with the link in our bio. This is where experienced investors think differently, because a short-term drop shouldn't change a long-term plan. So here's how experienced investors think differently and how you can too. 1. Focus on your goals, not the daily price movements. A 5% drop on Sunday, not a crisis. Your long-term goals aren't decided by one bad day. History proves that investors who stick around through the dips are the ones who catch the biggest recoveries. 2. Expect volatility. Don't be afraid of it. When you rewire your brain to expect the unexpected, sudden drops don't feel catastrophic. They just become a part of the ride. 3. Execute your strategy, don't react to headlines. Your strategy is your GPS. Ignore distractions and detours, and you're far more likely to reach your destination on time. And here's the truth. Making emotional decisions can literally cost you thousands over time. Master these mindset shifts, and you'll have the skills to profit while everyone else panics. That's another reason why ETFs are so popular with investors. Unlike investing in single companies, ETFs give investors exposure to hundreds of companies in different industries. So when one company goes down, there's usually another company enjoying the upside. While it might not protect you from all market volatility, investing in ETFs can help smooth out some of the market bumps and make your portfolio more resilient. Today, you learned that market volatility isn't the enemy. Emotional decisions are. In episode 7, we'll walk through what Tom tracks in his portfolio, how he knows when to rebalance, and how he keeps growth on track without overcomplicating things. See you in episode 7. Thanks to iShares by BlackRock for supporting this series and helping to bring investing education to more Australians. Check out the link in our bio to learn more.